Black Monday.
They're calling it the Monday Massacre.
Wall Street had its biggest one-day drop in history.
The results of the decline will hit millions of people.
Up until this point, your friends probably thought you were some kind of genius, but now they're urging you to sell. But you ignore them, and slowly but surely the market recovers until
the Nasdaq index in freefall, down nearly 10%.
Driven by technology in general and the internet in particular.
Traders and investors shell-shocked.
your friends are on their knees begging you to pull your money out, saying things like it's time to take your profits before you lose everything. But you hold strong and things start going back up until you're hit with...
It was one of the most profound events in generations with huge consequences.
Little did you know, you're in for the ride of a lifetime until...
The global economy will contract by 3% this year, the worst downturn since the Great Depression.
Surely this is the end of the stock market. But as things reopened, the market soared 27% from its low, setting new records. What a comeback. Something I didn't mention is the guy that invested his money in 1985 was actually me when I turned 18 years old. The average return over this time period was 11.23% per year. So if I'd have only invested $250 per month during this time, then I would have made $1,841,521.08. That's a return of over 6,000%. But between us, I invested a lot more than that. So now you understand the power of investing, I think it's time to jump into the details. Honestly, it's amazing how many people talk about investing, but don't actually show you how to do it. So I'm going to quickly walk you through how to invest in stocks on your phone. Of course, remember, I'm not a financial advisor. This is just the way I do it. And before you do any of this, make sure you have an emergency fund of 3 to 5 months of living expenses. The first thing on our list is to set up an account. A lot of people get stuck at this stage as there's a lot of different investment platforms out there and also different types of accounts. But trust me, it's much more simple than it first seems, especially now you can do it all online. When I first started investing, I had to phone up the stockbroker every time I wanted to buy a stock. Let's use the Trading 212 app. I'm going to be using my son's account as my account's pretty messy as it has a bunch of free shares. He's actually been running an experiment on here for the last 3 months, but we'll talk about that in a bit. The account you open should be a tax advantaged one. This means you won't have to pay any unnecessary taxes. These are known as stocks and shares ISAs in the UK and Roth IRAs in America. I think the UK option's much better as you can invest up to £20,000 a year without paying capital gains tax on your profits, and you can take out your money whenever you want. In contrast, Americans have to wait until they're old and retired, and they have a much lower limit of $6,500 per year. Feel free to use whatever app you like. This is just one of my personal favorites. Next, we need to deposit some money in order to start investing. Most apps make it pretty easy to deposit money. We just have to click these 3 lines and then select deposit funds. As you can see, this brings up a screen with lots of different options like instant bank transfer, debit card, and what we're going to use, Apple Pay. Let's just put in 400 so we can invest in some stocks together. Feel free to invest whatever you feel comfortable doing. Curtis, I'm going to need your face for the phone.
All right, hang on.
This next step is super important. Getting some free stocks. Since I was planning to talk about Trading 212 anyway, I reached out to them to see if they would be interested in sponsoring this portion of the video. They agreed and they're offering a free stock worth up to £100 to anyone that uses the code Tilbury when they create an account. Plus you can get more free shares by inviting your friends. Both of you will get a free share as long as they fund their account. So don't waste your invites and invite brokies. And also don't worry if you've already opened an account within the last 10 days. You can still use the promo code Tilbury in the app and receive your free share. Right. Now we need to plan a winning strategy. The first thing we need to remember is that investments go up and down, so it's very hard to pick winning individual stocks. That's why I prefer to invest in all of them. You probably think this sounds a bit crazy, but stay with me. I love listening to music. I'm a big Deacon Blue and Queen fan myself. But whatever you like, if you've ever listened to the radio or used Spotify, you'll be familiar with the music charts. The better the songs perform in sales and downloads, the higher up they go in the charts. On the other hand, if a song drops in popularity and sales, then it drops out of the charts. This is almost exactly the same as investing in an index fund. All you have to do is switch out the songs for companies. Let's take the S&P 500 for example. This is a list of around 500 of the largest public companies in the USA. The big dogs being Amazon, Google, Apple and Tesla. And just like the music charts, if a company does poorly, then they risk being removed from the list. Here's the cool part about an index fund. With just one click, you're not just investing in one or two companies, but in every single company on the list. So if one doesn't perform very well, your money's okay as you're spread across all of them. So how can we put this into practice? Well, we need to automate our long-term investments. Remember I said my son had been running a little experiment for the last 3 months on his account? Well, he's been investing £5 into the S&P 500 every day. Why £5? Because that's about the average price of a Starbucks coffee. Automating your investments like this is a great idea, as it means you can just set it and forget it. His portfolio is actually doing pretty well. As you can see in the green, his return so far is £36.46, and that's a return of 5.03%. Not bad for a little experiment. Cutting grass so he could provide for me and my mum and my 3 sisters. He'd stash away any extra money he made in a shoebox, as well as a bank account that paid little to no interest, hoping that one day he could quit his job working in the factory. When my uncle invested some of his money in the stock market, my dad said it was an extremely risky move. Unfortunately, what my dad didn't realise is that he was also playing a risky game. Can you see where this story's going? Every year my father's money was losing value due to inflation. This is just what happens over time. As more money is printed, the money in circulation becomes less valuable. This meant he was never able to quit his job in the factory. The thought of my money being eaten away by inflation scared me so much that I've made sure to invest throughout my life. As a result, not only have I beaten inflation, but my investments actually now grow by around $17,000 a week on their own, which over my lifetime has made me millions. I'm no financial advisor, but I am someone that's been there and done it. That's why I'm making this video. It's exactly what I wish I had when I was younger. How can I make money investing in stocks? To make money, we first need to beat the inflation issue. In the last 60 years, this averages out to a rate of 3.8% per year. So if your money isn't growing by more than this on its own, then you're getting poorer by the second. In a perfect world, you would have a savings account that provides an average return of 8 to 10% every year, so that you can both beat inflation and earn some profit. Unfortunately, such savings accounts don't exist. However, you can achieve returns like this by investing in the stock market. A stock is a small part of a company, and when you buy it, you become a shareholder. And when you're a shareholder, there are 2 ways you can make money. Firstly, if the price of the stock goes up during the time you own it, you can sell it for more than you paid. Secondly, you can receive dividends. Dividends are regular payments to shareholders. Not all stocks pay dividends, but if they do, this means that you can receive money without ever selling your stock. The magic really starts to happen when you own a bunch of stocks that grow at an average of 10% per year, because the interest applied becomes larger and larger. This is called compound interest, and I have to admit a guilty pleasure of mine is messing around with online compound interest calculators. Let's do one now. If you were able to invest $250 per month at an 8% annual return, in 42 years, you'd be a millionaire. And if you continue to do this for another 10 years, you would actually have over $2 million in your account. Of course, if you wanted to invest even more, then that would just speed up the process. This is all based on historical average data and it isn't guaranteed, but it's certainly been my experience. So as you can see, the real secret ingredient to this millionaire formula is time, which brings me on to, when should I start investing? The short answer to this is as soon as possible. The younger you start, the better, as you're giving your investments more time to grow and compound. This also means you can take more risk, as your investments have time to recover if a stock market crash happens. And it will happen. It always happens. But life isn't as easy as this, as there are often things in the way preventing you from investing. So here's how I would structure things. First, you need to make sure you've paid off all high interest debt like credit cards. Just think about it. There's no point trying to make 10% in the stock market if you're paying 15% to a credit card company. Secondly, build up an emergency fund. This should be enough to cover 3 to 6 months of your living expenses. This This way, you're not forced to sell your stocks in the event of an emergency, which can really ruin your progress. Once you've done both of these things, you're ready to start investing. If you're younger than 18, then it would be a great idea to ask a parent to open up a custodial account, which allows them to invest for you. This will give you such an advantage in the future. Your next question is probably something along the lines of, how much should I invest? When you ask an investor, they'll probably say as much as possible. However, I have a different opinion. I made most of my money through starting different businesses and only used the stock market to grow my wealth over time. I've also had a pretty fun life, from flying full-size aeroplanes and racing cars to competing for my country and traveling the world. If I'd invested all of that money into the stock market, then I'd have missed out on so much. So my answer would be to invest whatever you feel comfortable with. But if you want a more solid answer, then a 70-20-10 rule is a pretty good guide. It states that you should split your money by these percentages: 70% on living expenses, 20% on investments, and 10% on the fun stuff. Research shows that people who invest at this level are much better equipped to ride the ups and downs of life and also get ahead of everyone else. That's all well and good, but how do I buy a stock? There are various different apps out there that allow you to invest in stocks. I'll leave some links below. The key is to open the correct type of account. You'll often hear people throwing around the terms Roth IRA in the USA and Stocks and Shares ISA in the UK, TFSA in Canada, and Supers in Australia. If you don't have one of these accounts, then you're missing out, as they allow you to avoid paying taxes on your investments, but they do have limits because they're so powerful. A great thing about these investing apps is they actually give you the ability to buy fractional shares. So rather than buying a share of Apple for $190, you can invest as little as $1. I wish I had this option when I was younger, as it would have allowed me to get some early investing experience without having to take any big risks. One of my favourite investing platforms is Trading 212, as they do both of these things. Since I was planning to talk about their app anyway, I reached out to see if they'd be interested in sponsoring this portion of the video. They agreed and are also offering a free stock worth up to £100 to anyone that uses the code Tilbury when they create an account. One of the really cool things about Trading 212 is they let you practice investing with fake money, so you can get familiar with real data from the markets without risking any money. So if you're a little uncomfortable with investing or just want to try some strategies before putting your own money on the line, this is a great way to get started. Another great feature is called pies, where you can see how other investors have allocated their money into different stocks. If you wanted to invest $100 into that pie, then it would just be split amongst the various allocations that that pie creator has chosen. If you live in the UK or Europe, it's worth trying out Trading 212 because signing up is completely free and there are no commissions. Of course, don't forget to use the code Tilbury and you'll receive a free share worth up to £100. Or alternatively, click the link in the description to sign up and see exactly how to access the free share. Now the obvious next question is, how do I pick the best stocks? There are two main ways to attempt to predict the stock market. These are called technical and fundamental analysis. A good way to think about this is like a scale. Usually, short-term day traders are purely focused on the technical aspects. This includes looking at charts and patterns. They believe they can predict how the stock will change in price by judging the highs and the lows on the graphs. As a long-term investor, my strategy is about keeping it simple. Lots of people talk about using margin and options, but that's really not something I worry about. I'm a lot more focused on the fundamentals of a company. This includes the financials, the leadership, and the brand recognition, as I believe this is where the true information lies to indicate the long-term success of a stock. When I invest in a stock, I don't have an intention of selling it for at least 2 to 5 years. However, like I mentioned, it's a scale, so I do look at the occasional chart in order to find the best time to buy. This approach has helped me find some really good investments over the years, rather than just dipping in and out trying to make a profit every day. But with the majority of my investments, I don't actually do any of this, that's because I allocate most of my money to index funds. This is definitely the best strategy for most people. So, what's an index fund? It's a way for the average person to make more money than the professionals with very little effort. I'm a big football fan, and if you've ever followed any sports, you'll be familiar with a league table like this. The better your team performs, the higher up they'll be on the list. On the other hand, if they do really badly, they might be removed from the league entirely. This is almost exactly the same as an index. All you have to do is switch out the teams for companies. Let's take the S&P 500 for example. This is a list of around 500 of the largest public companies in the USA, the big dogs being Amazon, Google, Apple and Tesla. Just like the league table, if a company does poorly, then they run the risk of being removed from the list. With this league table or index of companies, you could go and buy stocks in some of them individually. However, if something bad happens to those companies that you've picked, then you can wave goodbye to your money. The idea of an index fund is to be a little bit sneaky, as it allows you to invest in every single company on the list with just one click. Even if a few companies do terribly, then it's balanced out by all the companies doing extremely well. The average annual return of the S&P 500 over the last 10 years has been 13.6%, although this is slightly higher than the average over time. No one has ever lost any money if they've bought and held an S&P 500 index fund for more than 20 years. The truth is that the average actively managed fund returned 2% less per year than the market in general. This means that the professionals on average are doing worse than index funds, and even if they end up losing you money, they still charge you high fees, no matter what. The reason that index funds can charge really low fees is because they're passively managed, which means they look after themselves and don't need an expert to keep adjusting them, meaning the fees can be as low as 0.02% per year. When I tell people about index funds, it often blows their minds. However, when they go onto an investing app, they get confused at the different options and ask, what's the best index fund to invest in? Well, as I said, I'm not a financial advisor, but I have had a lot of success with 3 different types of index funds. Number 1 tracks the S&P 500 index. This is the one we briefly mentioned before. The historical return of 8 to 10% has allowed me to generate a fortune over the years. This is due to the power of compound interest. The S&P 500 tracks 11 different industries/sectors, and no sector is more than 30% of the index. However, it is worth pointing out that it's a bit tech heavy these days, with 5 tech stocks dominating 23% of the entire fund. It's up to you if you see this as a positive or a negative. I personally don't mind, as I believe in the future of technology. There are so many different index funds that track the S&P 500, so here are some of my favourites. The best I found in the USA are the VFIAX Index Fund or the VU ETF. The best in the UK would probably be the VUSA ETF. The only real difference between an index fund and an ETF is that the ETF can be purchased or sold at any time throughout the day, just like a stock. Index funds can only be purchased in full. So for example, if the price is $500, you must pay $500. An ETF, on the other hand, can be purchased in fractional shares, which means you don't have to buy a full share, and instead you can invest whatever amount you like. This is great if you're just starting out or want to dollar cost average in. Personally, I've set up a direct debit every month so the money leaves my bank account without me even noticing. Really and truly, there isn't a huge difference between an index fund and an ETF. Just consider which one is best for you. Take the plunge. Number 2 is a total stock market index. The total stock market index has returned investors an average of 13% each year over the last 10 years, which isn't bad at all. It's the definition of diversification. You can't really get any more skin in the game for a lower cost. If you want to invest for a long period of time, completely wrong. What these people actually mean is that side hustles are too competitive and require a ton of money to get started. That's a valid concern. Making money requires a lot of hard work. I don't think I really mention this enough in my videos. It took me years of building different side hustles to become a millionaire. So if you want a quick and easy formula to success, then you won't find it here, or anywhere else for that matter, because it doesn't exist. However, I can give you a simple 5-step plan that you can apply to any side hustle you choose. Step 1. get good enough at something. Starting a side hustle is like playing a video game. You first need to increase your character's power by assimilating knowledge and developing valuable skills. Unlike Sims, your real-life avatar doesn't come with a ready-made six-pack. This is going to require some dedication. A valuable skill is anything you can learn that a large market is willing to pay you for in the future. Notice I said you just have to become good enough. That's because I don't think you should be wasting years of your life trying to become an expert before making any money. Look, I'm going to get straight to the point. Too many people go to university. Yes, knowledge is power, but unless you want a job in a traditional institution like becoming a lawyer or a doctor, there's little need to pay for traditional education. I'm a big believer in learning a skill whilst making money. I don't know why more people don't do this. My friend was the same when she became a counsellor. She felt like she had to become more and more qualified before she could charge for her services, even though she was already amazing at what she did. Now she's actively getting paid. However, just think how many people she could have helped and the money she would have earned if she'd have got over her mental block sooner. The same goes for you. There are people out there that need you now, not in 3 years' time. So it's time for you to decide what skill you want to learn. Remember, you need to make sure your skill has a wide enough appeal. I mean, if I decided to develop the skill of reciting the 7 Harry Potter books off by heart, that skill would be pretty useless when it comes to making money. Most people don't like to admit it, but they're extremely time rich and they could spend it learning a new skill, but instead they decide to chill. Now, that's okay if you don't want anything more from life, but the one thing I can't stand is people that complain about their situation and they don't do anything to change it. The truth is, society wants a docile population that goes to work, follows orders and collects their paycheck. That's why they continually pump out TV shows and films with blatant political messages, all designed to brainwash you. I mean, it's called programming for a reason. So a handful of examples of useful skills you can spend your free time learning are video creation, coding, negotiation, graphic design, writing, or even practical trades like carpentry, electrics and plumbing. The list goes on and on. There are so many side hustle ideas out there that allow you to be paid handsomely for leveling up your avatar. I mean, if you want to learn coding, then start building websites for friends. How about physical trades? Just help out a handyman on the weekend. And for video editing, reach out to work for an influencer. Step 2, offer a standout service. A few years ago, my son had become good enough at filming videos and editing them. He'd managed to teach himself these skills while posting to his YouTube channel, but he wasn't making much money. That's when he did something pretty clever. He decided to offer a standout service for clients. If you offer a normal service, for example, I'll film and edit your videos for $100 each, then you'll be lost in the crowd of competition. You'll be one of the many options for your customers. It doesn't matter if they're looking for a video editor, a web coder, graphic designer, or a salesman. They'll be comparing all of their options based on one thing, the price. This means that you'll always have to worry about competition, and ultimately, it's a race to the bottom, as there's always someone willing to work for less than you. That young lad who still lives at home editing videos is always going to be able to undercut you, as $10 to him is worth so much more than it is to you. I mean, he'd probably be one of the richest kids in the playground. The issue is being seen as a commodity. In other words, there are lots of different options and you're comparable to all of them. The solution to this is offering a standout service so that your customers don't see you as one of the many options, but instead the only option. This gives you the ability to charge far higher prices and build a much more lucrative side hustle. A standout service should look something like this. I'll create an action plan for your social media strategy, direct a bespoke promotional video, help you with your on-camera delivery, and use my experience in your sector to gain new customers and fans that will rave about your services. Let's break this down into 3 parts that you can replicate to make your own standout offer. The first one is niche. Although your skills only have to be good enough, your client should still look to you as an expert in their particular sector. This applies if you're looking to become a social media manager, Facebook ads expert, drop shipper, consultant, and so many more. People are much more likely to pay for someone that's positioned themselves as a specialist within a niche, rather than a jack of all trades. Now, the person that does everything might actually be better than you. However, they're not perceived in that way, and the way people see you is what matters. Before jumping into one of these, it's very important to evaluate what niche has the highest earning potential, and secondly, what you enjoy the most. In an ideal world, it'll be the same answer. However, it doesn't always work that way. Money is obviously very important, but you aren't going to get anywhere if you hate what you do. So it might be worth taking a perceived cut in income for more enjoyment, because in the long run, your motivation should make up for that loss of money. The second part of a standout service is financial incentive. In order to charge more for your side hustle, you need to make more money for your clients. Think about what skills you have or are planning to learn and how you can use them to make other people wealthier. It's so important to sell this financial incentive rather than the actual product, such as the video, website copywriting, and so on. No one really cares about that. They only care about what that product will do for them. The third part of a standout service is skill stacking. This is essentially taking all the valuable skills you've assimilated in level 1 and slotting them together like a jigsaw puzzle. In my example, this is of course the social media skills I'm using to create their action plan, production skills to create the video itself, and directing skills to make sure their on-camera delivery hits the mark. Step 3, productize your service. Once you productize your service, you can sell it to multiple people. This will allow you to make a lot more money without drastically increasing your expenses. Productized services enable you to expand your side hustle and serve more customers without dedicating an excessive amount of hands-on work to each project. The model is repeatable and should only require modification. In other words, you shouldn't have to make any massive changes when adapting it to different clients or projects. To make a productized service, you'll need to outline precisely what your customer will get and at what price. You'll then be able to sell this product many times. The customer is still receiving a service, now with the appealing predictability of an off-the-shelf product. There are endless possibilities when it comes to productized services, as they're only limited by the creativity of the service providers. Early enough to become a millionaire. On that note, about a month ago, I gave Laura $1,000 to invest however she liked. She'd never done anything like this before, and you guys loved it so much that you've been asking for an update. So here it is. Firstly, we discuss how to overcome the fear of investing, because it's all about getting started.
Not really for me. I don't really know much about it. Bit risky.
Next, we'll be revealing how much money she made.
So I put £240 in and it's now worth.
And finally, unpacking her plans for the future.
Not many girls, I feel like, are investing into it. I kind of like to be there and go, nope, we can do it as well.
Watching this video all the way through will put you in the best position when it comes to making money from investing, as we're going to be showcasing real results with realistic amounts of money. So make sure to smash that thumbs up button for the YouTube algorithm, and we'll get started straight away. Hi Laura, how are you?
Hi, good, thank you. Thanks for having me back.
Yeah, you're more than welcome. You know what, it's been a couple of months since we started this investing journey.
That's gone so quickly.
It certainly has. So what I really want to know is, what did you actually think about investing and what are your thoughts on it?
So before I kind of started, I was a bit apprehensive about it, didn't know much about it at all. But the best way to start learning more and more and become really invested in the whole investment process is to actually start. So that was great that you gave me the ability to start doing that. I think it's just the unknown and the whole link. It kind of seems a bit like gambling. I think you have to just kind of build the trust in it and learn for yourself and know that if you invest and you lose some, then that's you can live with that.
So it's more of a misunderstanding, isn't it? And probably because it's not been taught in schools to give people the confidence to go ahead and to do it. And what about your friends as well? Because that's another key thing, isn't it? So have you spoken to any of your friends about the investing?
I have a little bit. I know I mainly spoke to my brother about it, and I was trying to get him to sign up for a free share, and then it's just the signing up process for him.
Yeah.
So once he signed up, I think it'll be fine. And I was going, look, Mark and Curtis do this, it's absolutely fine. But yeah, it's just building that trust. And I think as he sees whether my investments have done well and things like that, I think he's just keeping a little sneaky eye on mine, and then he might do it himself as well.
Yeah, I think that's always a bit of a shame to look at it that way, from the way he's looking. at your investments and only going to go into them if they go up. I think people need to look at them as a very long-term thing that you're putting money into over a period of time. So maybe you can give them a nudge and say, look, don't wait, because there's no time in the market. It's time in the market that you need. You've got to stay in there.
You've also actually just reminded me of something he said the other day. He said whether he was a bit too late to the Tesla. So I don't know whether, because there's so many stories about people having shares and coins and things, and then it goes up exponentially, and then they wonder whether it's going to plateau or go down from here.
Well, that's the whole thing about time in the market. Nobody really knows where the market's going to physically go. Now, if you take Tesla as a prime example, if I said to you Tesla's going to be $2,500 this time next year, would it be too late to invest? No, exactly. So, we don't know where it's going to go, and trying to time that market will mean you'll never actually get in, because the excuse to get in will be, oh, the market's too high, and the other excuse will be, oh, it's falling, I don't want to get in while it's falling. So there's always an excuse not to invest, and that generally stems around people trying to time the market. So I think you might need to have a word with him.
I will. I feel bad now. Sorry, Michael.
So you mentioned a free stock there, and that's a really good way to get started. And we've partnered up with public.com in the USA, who are actually offering you a free stock worth all the way up to $1,000 when you sign up. And if you're in the UK, you can sign up to free trade, and they're offering a free stock worth all the way up to £200. It's basically free money, and I'll leave the links in the description below if you're interested in getting started. Let's talk about stocks. Can you remind us all, because we all want to know, what stocks you bought?
Yes, so I bought Tesla and an S&P 500.
Okay, so how are they performing?
They're actually doing really well. I feel like there's been a little boom in the market at the moment. So,
okay, well, remind us how much you invested first of all in each stock, and then we can see where it's gone from there.
Okay, so in Tesla, I put £200, and it's now worth £341.82p.
Wow.
So the gain is £141.82, which is in dollars 190.
That is unbelievable, isn't it?
I know, it's crazy.
And how much work did you actually need to do to generate that money?
Absolutely nothing, apart from checking every now and then, because I got so excited, and it goes up and down, and then it just kind of went up.
And that's really because they've come to an agreement with Hertz to supply them 100,000 electric vehicles, and that's the equivalent of a $4.2 billion deal. Not only that, in Europe over the last 3 months, Tesla Model 3 is the best selling car. Not the best selling electric car, the best selling car, period. So, what great news when you've got shares in Tesla.
Yeah, definitely. I can kind of tell as I'm driving on the roads, I see more and more Teslas pop up everywhere. So,
well, it used to be a rare sight, didn't it? I remember when I first suggested to Curtis that we get a Tesla, that it was like, well, no one's driving them. You never see any of them about. They can't be that popular. And we really did look, you only saw them now and again. Now they are literally everywhere, aren't they? And they've got a good charging network. That's all I can say. That certainly helps the Tesla brand, because you can charge up quickly, and it just works. We're really happy with ours, and it seems that it's the growing thing.
Yeah, definitely. And the kind of move in the future to all electric cars, I know that's kind of been pushed back again recently, but yeah.
And that gain is in a 2-month period as well. 20s think they're invincible. I know I certainly did. I think I was a bit, to be honest. But actually, the truth is, in your 20s, you're more vulnerable than ever. If someone makes a financial mistake at this point in their life, it will send shockwaves through their entire future. Each of these mistakes is very different, so it's really, really important that you watch this video until the end. Otherwise, you could fall victim to one of them. So smash that like button. All right, done that? Let's jump straight in. Number one, it's not taking advantage of your free time. Now, in your early 20s, you are incredibly rich in one way. You've got bundles and bundles of time. You can do so many things to turn your spare time into cash. And if all you're doing is wasting your time, then all that potential income is just slipping through your fingers. This is also the ideal time to invest in yourself. and build your skills. I used to use my spare time in my 20s sketching model planes, and this has led me to having them manufactured and selling them all around the world. In fact, one of my biggest designs is the biggest selling RC aircraft in the UK. The original design for this was sketched in a classroom while I was being bored by the geography teacher. I remember him well, Mr. Woolard. So developing those skills from an early age has served me very, very well. Number 2, trying to keep up with your friends. Everyone has that one friend that always seems to have the nicer car, the nicer house, and sometimes the hotter partner. Let me tell you a secret, all right? The majority of people are faking it anyway. As of 2020, the average American household had a credit card debt of over $5,700. This is astonishing, as it means the friends you're actually trying to keep up with are probably more in debt than you are. Having access to so much easy credit allows people to rewrite reality. At the end of the day, friends that need impressing are not true friends. Real friends are the people that love you no matter what. They stick by you through your troubles and are there for you when you need them. They are the people who couldn't care less what you spend your money on. Number 3, over drinking and partying. When you're out drinking, it's easy to get caught up in the moment and spend a lot more money than you usually would. Now, this is most people's kryptonite. It's one of the things that keeps many people broke and, of course, unable then to invest. I'm not saying that going out and enjoying yourself is wrong, as you have to do what makes you happy. The key takeaway from this is everything is great, but in moderation. You may think that saving a few dollars here and there won't make a difference, but your dollar is worth so much more when you're younger. By investing it instead of spending it on something you really didn't want anyway, it's going to be worth dramatically more in 20 years' time. Number 4 is putting off retirement investing. When you're in your 20s, retirement seems like a lifetime away. Many people put off investing in their retirement until they're about 45 or 50 years of age because of many, many excuses. They've got a mortgage to pay, they've got a college fund to save for, and of course there's holidays. These lost years can cost you very, very dear. So let me explain. If you invested $100 a month for 30 years at 7% annual return, you would have $116,945 set aside in your retirement fund. And this can continue to grow until the point you decide to retire. But if you put off investing in your retirement, let's say 10 years, and you start investing the same amount for a 20-year period, wait for it, you're only going to have $50,000 in your retirement fund. Yes, it can grow, but you're starting from such a low base, just $50K. $50,000 is a huge amount of money just to lose. And the reality is that $50,000 would have only cost you $12,000. So lots of free money. I was very lucky. My mentor advised me to save and invest in a pension from the age of 18. I've always been told that you should put at least, not a minimum of at least 10% of everything you earn, and it's given me the ability to use that money in lots of different investment opportunities, such as business, real estate, and also stocks and shares. Even Einstein said, compound interest is the 8th wonder of the world. Number 5 is not having a backup fund. Now, over 60% of millennials wouldn't be able to cover a $1,000 emergency. That's 60% wouldn't have enough money for a minor emergency. Now, I know I bang on about this, and I do bang on about it a lot of the time, about having a backup fund, but that's because it's super important. I learned it the hard way. When I was 19, I purchased a car that I needed a loan to buy. The engine in it lasted me about a month before it blew up. You can benefit from the chaos. I've been investing for more than 35 years, and as you can imagine, during that time, I've experienced lots of these crashes. However, I always seem to come out the other side wealthier than before. So today, I want to share the knowledge that has helped me make millions through multiple market crashes. By understanding these strategies, you can spot the warning signs of a crash and use them to your advantage. So how common is a market crash? Well, there are 3 different types of market decline. First is the most common type of decline, a market correction. This is defined as at least a 10% drop from a recent high. These can be caused by various factors, but think of it as the stock market realizing it's getting a bit expensive and cutting back prices. On average, these have happened around every 1.2 years since 1980. The second most common type of decline is a bear market. Now, you know when you're in a bear market when prices have dropped more than 20%. Since 1932, these bear markets have popped up on average every 4 years and 8 months. They tend to keep dragging the market down for about 289 days, or roughly 9.6 months. Sure, that sounds like a long time, but keep in mind that bull markets, which is when the market is going up, usually last around 965 days, or 2.6 years. The third type is a stock market collapse, which I class as an over 30% drop in the stock market, normally within a very short amount of time. Although these are very uncommon, they can happen. In my opinion, if Trump had been unalived, then this could have been a very real scenario. That isn't a political view, just a logical one due to the way the stock market reacts to this kind of thing. The main takeaway from all of this is that if you aren't ready for the stock market to go down sometimes, then you shouldn't be investing in stocks. So how do you spot a market crash? Well, let's discuss the 3 phases of a market crash so you'll know what to look out for. I'll also share the strategies I use at each stage, backed by real life examples from my experience. This way, you'll be better prepared than most investors. Remember, I'm not a financial advisor and this isn't financial advice. I'm just sharing what's worked for me over the years. Number 1, the euphoria phase. This is a stage where the market is at its peak and irrational excitement drives prices to unsustainable levels. During this stage, everyone is happy and flying high. When I start seeing this blind happiness, I prepare my investments for when everything comes crashing back to reality. Before the 2008 financial crisis, there was a couple of things that I noticed that really made me cautious about investing. First was the boom in consumer spending. Everyone had money. They were spending thousands and the economy was thriving. A more recent example of this is the NFT craze a couple of years ago. Never in a million years would I have thought that people would buy JPEG image files for millions of dollars. Things like this are a clear sign of too much money in circulation. The second thing I noticed in 2008 was the increase in the number of people buying houses or refinancing. This is because it was easier than ever to get credit as the housing market was booming, which meant if people were unable to pay their mortgages, then the banks could take back the properties without losing any money. Now, it's one thing noticing these little clues, but it's another thing actually taking action and preparing yourself. Between 2007 and 8, I could have just gone along with the crowd, as the general herd mentality was that everything was great and nothing would ever go wrong. But instead, I started to prepare my investments for the worst. At the time, lots of my friends and fellow business owners didn't quite understand the decisions I was making. They may have even seen me as a bit of a coward, but from my perspective, I don't think they understood how much risk they were taking. So if your spidey senses start tinkling, these are some of the things you can do to prepare yourself for the worst. First, I would evaluate and minimize your risk level wherever possible. Personally, I'm not focused on chasing crazy high returns as that's unsustainable for the long term. I just want to be making reasonable gains consistently so my money compounds. I always think about the story of the tortoise and the hare. I know it might sound boring, especially coming from a boomer, but slow and steady does win the race. If you're new to investing, there's a high chance you haven't experienced a real market crash. It can be horrifying to see your portfolio completely halving in value and sitting deep in the red for a brief period of time. So you have to ask yourself if you could mentally handle this kind of drop without selling your investment. Secondly, I would start to reduce my leverage. Now, on one hand, leverage is a great way to accelerate wealth, but it can also be very dangerous. The thing is, if a stock crashed too far, then your investing platform may issue a margin call, which means you have a limited amount of time to pay off your debts. And if you don't, your brokerage may sell your stocks at the bottom of the market to recover the money you borrowed. If this is something you're considering or even doing, then if I were you, I would be paying some of this debt off. I never use margin, but that's a personal choice, and I'm well aware that by not taking on this risk, I'm missing out on some potential profits. The truth is, I've seen too many of my friends go from millionaire status to broke in a blink of an eye, and now I just stay well clear of it. Thirdly, I'd start saving some extra cash in a high interest savings account. I know I bang on about having an emergency fund of 3 to 5 months of your living expenses, but I'm talking about saving even more. I did this between 2007 and 8. From the outside, it looked a bit strange. The market was booming, and by leaving my money in the bank, I wasn't taking advantage of it. However, I noticed that more and more people were getting interested in investing, which tipped me off that there was a bit of a bubble forming. You see, when everyone starts getting comfortable with the idea of investing, it can be a sign that things are about to pop, as pricing is being propped up by inexperienced investors. The trouble is that at the first sign of a crash, lots of these people panic sell, which drives the prices down even further, leading to a spiral of doom. Finally, in this stage, I would make sure my investments were properly spread out. This is called diversification, and it's one of the best ways to help withstand a market crash, as quite simply put, you haven't got all your eggs in one basket. This is all because you never know what sector is going to be hit the hardest. During the good times, it can be very common for people to do very well with one or two stocks and end up with most of their money focused in only a couple of different companies. Even if they start out with lots of different stocks, it can almost seem silly to put your money into other things when one stock outperforms all your others. Let's use some of my favorite stocks as an example. Say you have $1,000 to invest. Now, you could put all of that into Tesla with the hopes of it going to the moon, but if Tesla gets hit the hardest in a market crash, it won't be great news for your money. Whereas investing into a total US stock market fund would spread your money across multiple different industries. Look, nobody can predict if the stock market is going to go up or continue downwards. However, diversifying goes some way to reducing your risk. Yes, you can't guarantee returns, but at least you're investing in a broad range of sectors. Another great way to diversify while guaranteeing a return on investment is through something called a high yield cash account. Take a look at this, for example. Let's say you have $5,000 to put by with an additional $250 being saved monthly. Within 5 years, you'd have earned $3,493 without making a risky investment, because the account pays you 5.1% interest that compounds daily. Public offer this account with zero fees or subscriptions required, as well as giving you the ability to invest in thousands of stocks and ETFs with very low fees. I was planning on mentioning Public anyway, so I reached out to them to see if they were interested in sponsoring this video. They agreed and are offering a free stock worth up to $300 to anyone that signs up and funds their account. Just sign up for Public, deposit $20 or more, and enter the code MARK2024 via the Rewards Hub in the Public app. I'll leave a link in the description if you're interested, along with some other options if you're not in the USA. Number 2, the reckoning phase. I like to call it this, as everyone gets rudely punched in the face with the truth, and only the ones that know how to navigate it will be able to hold their nerve and make some money. This is the phase where the reality of overvaluation sets in, triggering widespread panic and sell-offs. What I'm trying to get at is in this phase, the stock market just comes tumbling down, and it's next to impossible to be unaffected. Even my son knew something was happening in 2008, and he was only 10. The number of customers that came into my hobby stores halved overnight, and even when they did come in, they didn't spend anything. On the bright side, I had lots of products which I owned and my warehouse ever since. I started out with no qualifications and no money, but still managed to become a multi-millionaire. And a big part of that was down to avoiding the 7 things I'm going to be sharing with you today. The first thing to avoid is working for only money. Imagine for a moment that you got a boring but well-paid job. You quickly start stacking some nice cash as your earnings grow. Your friends will think that you're absolutely killing it, and your parents would probably be pretty proud too. However, over time, your earning potential would start to plateau. This is path A. Now, imagine instead you get a challenging but lower paid job. You might struggle for a couple of years as you improve and adapt. You may even struggle to pay the bills. Your friends will probably think you're falling behind, and your parents may not agree with the path you've taken. However, over time, your earning potential will start going through the roof. This is path B. So, what's the difference between these two examples? Well, path A prioritizes money early on, whereas path B prioritizes two key things: skills and equity. Every self-made millionaire I know has followed path B, as it's the only way to build that kind of wealth. As I mentioned, I left school at 16 with no qualifications. However, I immediately went out looking for jobs and actually got offered more than 5 opportunities. So I had a big decision to make. Which should I choose? I decided to become a carpenter's apprentice. The pay wasn't great, but I knew the skills I'd learned would be extremely valuable, so I prioritised those. There was no way I was going to get equity in the business, but at least I was working for more than just money. That job taught me a lot, and although I was forced to quit after being relentlessly bullied by my manager, I still use many of those skills today when I'm designing my best-selling brand of radio-controlled planes that I sell across the world. By learning a wide range of high-income skills, it makes it almost impossible for you to ever be broke again, as you become your greatest asset. I like to think every job I had when I was younger added to my skill set like a Swiss Army knife. Nowadays, I'd recommend prioritising online-based high-income skills such as copywriting, video editing and coding. The demand for these skills is only growing, and I can speak from experience that there is a huge skill shortage at the moment. Sure, there are lots of people doing those things, however, 99% of them are just not up to standard. Honestly, your competition really isn't that tough. Now, let's move on to the second thing, equity. This just means owning a percentage of a business so you can benefit from the profits. My radio control model brand is a perfect example of this. You can gain equity in a few different ways. The most obvious way, and the way I did it, was to start the business myself. However, you can also gain it by working for it if you're extremely skilled in certain areas. This is known as sweat equity. Lastly, you can purchase equity in certain businesses, although I wouldn't recommend this as much unless you have the skills that can help accelerate that business forward. My friend Simon Squibb often goes around in public telling people to start their own businesses or ask for equity from their boss. While I 100% agree with the sentiment, you need to have some self-awareness with this. Firstly, it's worthwhile working for someone to gain skills before starting a business of your own. Secondly, you need to be realistic. I didn't think for a moment that I'd get equity in the carpentry business when I was an apprentice. So when you ask, make sure you have a solid case for why you deserve it and how you can add value to the business instead of just taking from it. You need to first focus on becoming someone worthy of equity. The main takeaway here is that too many people get blinded by money, forgetting the importance of skills and equity. This is the biggest trap. The more you obsess over earning just money, the less you'll likely make in the long run. The second thing to avoid is buying a luxury lifestyle. Picture yourself cruising through Dubai's sun-drenched streets in a bright yellow Lamborghini. You pull up to a swanky restaurant and order a $500 fillet steak without batting an eyelid. How does imagining that lifestyle make you feel? Pretty successful, right? Well, here's the truth. Most people you see living this way are far from successful. The majority are paying for cars they can't afford, taking trips to Dubai on credit cards they'll spend 5 months paying off, and ordering steaks at Salt Bay's restaurant that leave them with a bill they can't handle. These people are living a lie, pretending to be rich while drowning in debt. It's all smoke and mirrors, as it's much easier to impress others on social media than build real wealth. Seeing people live these luxury lifestyles might tempt you to start playing the flexing game too, as you feel like everyone is living a better life than you. However, this is far from the reality. In fact, 37% of Americans can't afford unexpected expenses over $400. 39% worry they can't pay their bills, and 60% of American households can't afford to buy a new car. Once you've made your millions, you can buy whatever you want. That's the point of becoming wealthy. However, in the early days, you can't live like a king and build wealth at the same time. Instead of buying depreciating items like flashy cars, designer clothes and dining in expensive restaurants, invest in assets such as stocks, shares, crypto and real estate. These assets will increase in value and generate income that you can then use to do whatever you want. The third thing to avoid is doing everything yourself. You might be really great at what you do, But no matter how hard you try, you'll never be able to outcompete a group of talented people working together. Look at anyone who's made it big in sports or business. If you do some digging, you'll see they all had help. Let's take Elon Musk as an example. On the surface, it might appear like he's a genius entrepreneur who's achieved everything single-handedly. However, that couldn't be further from the truth. He was part of the group that launched PayPal. When eBay acquired PayPal for $1.5 billion in 2002, these newly wealthy tech experts spread across the industry like a virus. Now they're known as the PayPal Mafia, as they've become such a powerful group. After leaving PayPal, they started many successful companies. These include big names like YouTube, Yelp, LinkedIn, and SpaceX. They often invest in each other's projects and give advice. But what if you're not aiming to launch the next billion-dollar company and instead just want to earn some extra money with a side hustle? Well, a lot of older business owners are kind of lost when it comes to everything tech-based and using the internet for their companies. I mean, a lot of them don't even know there's online tools for literally everything, whether it's managing your team, handling invoices, keeping track of projects, or even building a website. I don't blame them, as back in the day, we didn't have any of these things, but now the younger generation has a real advantage. So if these older business owners don't know how to do a lot of this online stuff, and they understand they can't do everything themselves, guess who they need? You. You can help them bring their businesses into the 21st century and make a lot of money in the process. It's all well and good saying this, but how could you actually do it? Well, if you want to give this a try, then I'd recommend using an all-in-one management platform. Odoo is a great choice as it includes the tools I just mentioned and more all in one place. Here's a great example of a website that needs a proper update. It looks like it was built over 10 years ago. Let's jump on Odoo and make something a bit more up to date. So I'm going to go over here and select the e-commerce app option. Now let's fill this in. I want a business website. There we go. And I want for my gardening business. After this, I've got the option to choose my color palette here, but instead, I'm just going to add their logo so that Odoo just builds a palette based on their brand colors. Now we've got to pick a theme. All these look pretty good, so let's go with this one. I can use the drag and drop feature to easily edit the page and customize images. They also have this cool AI tool to help me out with words. Let's fast forward about 30 minutes and I'll have something pretty cool to show you. Check this out, it's way better than the old website in my opinion. You could make some serious cash helping out older business owners with all the different apps on Odoo, or even use it to manage your own business. I reached out to Odoo to see if they wanted to sponsor this portion of the video. They agreed and are also giving you your first application free for life with unlimited support and hosting. And the cherry on top, Odoo offers a personalized domain name for 1 year. So if you want to give this a try, then check out the link in the description. The fourth thing to avoid is having too many inputs. Do you ever feel like you're being pulled in a million different directions? This happens with everything in life, from side hustles to fitness training. Everyone seems to have a different opinion on what you should be focusing on. It can look a little bit like this. This is you, and these are the people telling you what they think you should be focusing on. For the sake of simplicity, let's just call them inputs. All these inputs create hundreds of paths you could follow, like becoming a doctor, entrepreneur, joining a family business, getting a stable 9-to-5 job, traveling, and having a family. Let's call these your potential paths. The sheer number of these pathways can create something called cognitive overload, which is where your brain simply can't cope with the overwhelming amount of information and choices. So what's the solution? Well, I've always started with my end destination in mind and worked backwards. Of course, I didn't know exactly what I wanted to do in the future. However, I had a decent idea. I then made sure to only listen to inputs that helped me reach those targets. The clearer your goal, the easier it becomes to select the right inputs to help you achieve it. So limit the number of opinions you receive and prioritize quality over quantity. Most people have too many opinions being thrown at them, but not from experts. Cut out general opinions and instead seek expert advice. This could come from a mentor, someone successful in your field, or even educational videos from experts like myself. By doing this, you'll get more valuable, focused and specific guidance for your end goal. Remember, even when you work your way backwards, you still don't need to know everything at once. Fully listen and implement what you learn from an input, and then when you're facing another challenge, you can seek out more inputs that will help you overcome it. If you don't do this, then you'll get mental fatigue, which can lead to decision paralysis, where you find yourself unable to take action or move forward. Some people might even mistake this for being lazy, but in reality, your brain just gets overwhelmed. The fifth thing to avoid is being ego-driven. Let me start by saying this. Arrogant people won't even finish this video. They think they already know everything, so why bother sticking around? But that's exactly the problem. Arrogance blinds you to the opportunities that could genuinely change your life. Ego-driven people are often too focused on the big picture, constantly dreaming of the end goal. This might sound productive, but it's a dangerous trap. When you're always looking too far ahead, you end up overlooking the small but crucial steps that lead to true success. For example, some might be tempted to scroll through this video just to see all 7 things rather than sitting down and actually absorbing the knowledge in each one. But by doing so, they miss out on the valuable insights that could fast track their journey. When you're too egotistical, you start to believe that you don't need advice from others, especially those who might know more. Probably know I've got a bit of an obsession with turning $100 like this into as much as possible, and I think $100 is the perfect starting point, as I feel that most people will be able to find this amount of cash by doing some sort of side hustle or working some overtime. Today I wanted to do something a little different and introduce a time limit, so all the money making ideas I'm going to be discussing with you today should be able to turn $100 into $1,000 consistently over a 24-hour period. But Mark, if it was really that easy, everyone would be doing it. Well, this certainly isn't going to be easy. So if you think that, then please stop watching the video right now. I'm not going to lie to you, this will be hard, but the rewards are definitely worth the grind. But seriously guys, I've always believed that getting rich is entirely possible. However, getting rich easily just doesn't really exist. So I'm going to be starting with the least risky ideas and working my way up to the riskiest ones. But before we get into this, make sure to hit that like button for the YouTube algorithm, as it really helps get this video out to more people like you. The first one is creating digital products. I'm putting this as number 1 on the risk scale, as you might not even need the full $100, provided you've already got a laptop or a PC. The internet is definitely the place to make lots of money, as its growth has been absolutely huge. Just in 2020 alone, there were 305,000 online businesses created, compared to just 13,000 in 2019. With all these people starting online businesses, you may think that the competition is going to be sky high, and yes, of course it's harder. However, I think there's a huge gap in the market for digital products. Just think about it, everyone is talking about e-commerce and drop shipping, but far less are actually selling quality digital products which have the benefit of never running out of stock and no shipping costs, as it's all done over the internet. The thing I love about digital products is it can be fairly passive. Of course, no income is truly passive, but if you can create a digital product once, you can sell it over and over and over again. This sounds great, but what actually is a digital product? A friend of mine created a digital template system you can use on Instagram just off the back of a problem sent in by one of her followers who wanted to stand out. Within a couple of hours and no more than $100 invested, the templates were designed, and now she sells thousands of dollars worth every week. So you could use your $100 to buy some editing software to create these products. Or you could even pay someone on platforms like Fiverr to do the work for you. Then you could list them on websites like Etsy and start making some sales. I've seen these templates selling anywhere from $5 to $100 plus, and you only have to make it once and it sells again and again. That's the beauty of it. Once you've got some more money to play with, nothing is stopping you from running adverts on Facebook and reaching even more customers. But if Instagram templates aren't for you, then it doesn't stop there. You can make software, YouTube banners, ebooks, games, email templates, or even online courses. Creating and selling online courses is a booming market internationally, and in my opinion, it's one that's lacking a lot of quality. There's a massive demand for quality courses that teach useful skills skills rather than all the fake gurus who sell theirs for $997. I feel like they have given the e-learning market a bad name. However, it's expected to exceed $325 billion by 2025 and with a yearly growth of 5%. The second one is starting a service-based business. I'm putting this at number 2 on the risk scale as the initial setup is pretty straightforward with only $100. This type of business is only really limited to your time. If you're prepared to put in lots of work, then you will be able to turn your $100 into $1,000 consistently once you've built up your client base. Some jobs you can make an absolute fortune from doing because your customers don't feel it's worth their time. And I have to be honest, I agree with this. I'm typically busy with business and it doesn't make sense for me to waste 2 hours washing my own car when I could just pay someone $20 to do it for me. And this is something you can take advantage of. Washing cars could be a great service-based business to get into, but it probably won't make you $1,000 a day unless you become a professional detailer or start employing your friends to work for you so they can serve more of your customers. Once again, it's all about getting creative with the service and value you can provide your potential customers. My son Curtis is 23 and he is behind a lot of the strategies that helped my YouTube channel grow from 0 subscribers about a year ago to now over 700,000. Because of this, he can now comfortably charge over $2,500 for a few hours of his time as a consultant. The list is endless: mobile dog grooming, dry cleaning, delivery and pickup, mobile locksmiths, mechanic, and that's just to name a few. It's all about playing to your strengths and finding a unique mixture of skills that can add a lot of value to your customers. Maybe it won't make you $1,000 in your first day, but with some hard work and dedication, you could absolutely scale it up to $1,000 a day and beyond. Next up is reselling. I'm talking flipping items from garage sales and charity shops. I'm putting this at number 3 on the risk scale, as with this strategy you will have to purchase the items before actually selling them. This means that if you make a mistake or buy something no one wants, you may be stuck with the item and no profit. At garage sales you will have lots of motivated sellers because they probably just want to clear out their house. This means some valuable items get very easily overlooked. Just think how many priceless Pokemon cards were sold at garage sales. When I was younger, this wasn't as easy to do as I didn't have a phone with an internet connection, but nowadays you have such an advantage. Of course, it helps to do some research before to know what you're looking for, but whenever you're unsure about the item, all it takes is a quick check on eBay to see what the market value is. You even have the advantage of putting your negotiation skills to the test. If you can manage to get the price down, you'll make even more profit. I recently turned a $100 purchase of second-hand model trains into just over $1,000 because 2 of the items happened to be very rare. I gave a fair price based on what I thought I could sell everything for, and then as luck would have it, I had people fighting over them on eBay. I had a bidding war on my hands, and it's a great thing to watch as the price just keeps going up and up and up. You could spend the day hunting for hidden gems and then go home and sell them on global marketplaces like eBay, Etsy, Amazon and Facebook. This is the perfect way to sell them, as online shoppers can be lazy and not everyone can be bothered to go and find a good deal. Of course, you don't have to buy products at charity shops and garage sales. You can turn to the internet instead and hunt for some great deals. A good strategy I've used is searching for common spelling mistakes, as this allows you to find listings that no one else has seen, and therefore there's less competition when you're trying to bid for the items. I work out what I can sell the item for and then I offer 50% or less. I aim to at least double my money. And who knows, maybe you'll even scale this into a real business and begin buying inventory in bulk. I really believe that with a bit of skill and a large range of garage sales, you would be able to turn $100 into $1,000 within 24 hours. Let's now talk about buying materials to create physical products. I'm putting creating your own products as number 4 on the risk scale, as it does require you to have some creative skills and also the ability to do some proper market research to make sure people want your product in the first place. But with that said, by making your own products, you can generate much more money than reselling, as you're only paying for the materials. This means you have a much higher chance of securing that $1,000 profit per day. When I was younger, I used to build literally hundreds of radio controlled cars. I was friends with a model shop owner, and I noticed that many customers didn't want to build their own cars from scratch, as all they wanted to do was race them around. So after identifying this demand, I decided to buy the materials tutorials and charge a minimum of $30 for my time. It took me 2 hours to complete each model, so in 24 hours I could make $360. But that was way back in the 1980s, so you could definitely charge more for your time now and possibly hit that $1,000 mark. This could apply to so many areas, and all you need to do is promote yourself online, be it building model cars, making arts and crafts, or even building furniture. Now that takes me back to my carpenter days, that's for sure. Now let's get into crypto trading. I'm putting crypto trading at number 5 on our risk scale because it's such a new investment, which means certain coins can be extremely volatile, sometimes even shooting up over 1,000% within a few days. Of course this is very exciting, but it also means the opposite is true and you could end up losing all of your money. You may be wondering why I've skipped investing in stocks and dived straight into crypto. The truth is, it's just not very common to make $1,000 from $100 investment in the stock market over a 24-hour period. Of course it's possible with certain penny stocks and short squeezes like the GameStop situation, but these are often hard to spot. Because of the juicy returns from crypto, I've actually noticed a decline in the amount of people interested in the stock market, especially from the younger generation. The thing to remember here is that although stocks might not be as exciting, they can still offer some great returns over the long term and have been around a lot longer, so are generally regarded as a safer bet. On that note, public.com is currently giving away a free stock worth all the way up to $1,000 if you're in the USA, and Freetrade are giving away a free stock worth up to £200 if you're in the UK. I'll leave the links in the description below. But back to the crypto, a crazy statistic I found was that 13% of